It's time for Yahoo Finance's Market Minute. Stocks pairing earlier losses, turning positive as investors navigate those changing tariff policies. European automakers still under pressure after President Trump announced 25% tariffs on all foreign cars that should go into effect April 3rd. Porsche and Mercedes-Benz Group facing a potential $3.7 billion blow off those tariffs. And shares of American automakers falling sharply. GM, Ford, Stellantis all build a portion of their vehicles in Canada, Mexico, and China. Investors anticipating higher production costs for those car makers. Meantime, Tesla and Rivian moving to the upside. The EV makers potentially better positioned as they assemble their vehicles in the United States. Analysts at Bernstein saying Tesla is the, quote, clear structural winner, citing strong market share and better insulation from trade risk. That's your Yahoo Finance Market Minute. For more on what's trending, scan the QR code to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Checkup. One portfolio manager makes the case for a Magnificent Seven recovery in the coming weeks. And President Trump plans to implement 25% tariffs on imported cars and car parts. We'll talk to an expert about what it means for the prices consumers will pay for new and used vehicles. Plus, all this week, Wealth will discuss spring cleaning your finances. We'll dig into different areas of your financial life, your budget, your investments, your debt strategies, in order to get you on a good financial path for the rest of the year. All that and much more coming up during this hour. But first, we take a look at some of the market action. We're 90 minutes into the trading day and stocks reversing earlier losses as the global trade war escalates. President Trump announcing 25% tariffs on cars and car parts that are not made in America and threatening more tariffs on the EU and Canada if they work together against the U.S. Joining me now, we've got Ben Gutteridge, who is the Invesco Portfolio Manager of Multi-Asset Strategies. Now, Ben, you're expecting more volatility ahead. How are you navigating the market right now with this latest move from the Trump administration?
Well, look, I could well imagine. Nice to see you. I could well imagine it's sort of quite a daunting period to be investing, given policy uncertainty or policy that drives some anxiety. But we're not anticipating a deep contraction in equities because we're not anticipating sort of a deep contraction in the global economy or US economy. Yes, volatility, as you alluded to, but with consumer balance sheets still in good shape and the jobs market still in good shape, there is a resilience to spend there, and therefore, absent a recession, still think equities are the preferred asset class. And of course, I think it's well worth remembering that volatility really is sort of the price of entry to enjoy long-term returns. So as difficult as it is, we sort of have to embrace this volatility, expect it as sort of a regular feature. But given we don't think a recession is the immediate outcome, that gives us further encouragement to remain leaning towards equities.
So, Ben, where is the kind of broader analysis around what other areas of the consumer mindset some of the tariff action could overflow into? Because it seems like that's what the market was getting ahead of. And then we got the announcement on it specifically being about autos yesterday evening.
Well, look, the tariff issue policy agenda is one that's pretty hard to navigate and certainly hard to forecast. You know, there has been some movement of dates and sector-specific issues, and therefore, you know, there's evidence that it's a tricky one to play. But I think what we should feel relatively confident about is that this is a president that wants to make deals. I don't think it's just about putting a shield around the US. I think he wants to sort of either broker political wins as it relates to border control or actually change some of the trading activity. And I think there are deals there to be done. I mean, you think about here in Europe, the need for increased defense spending and increased energy purchases, given they can't sort of the current provider isn't considered a particularly reliable source. The US can play the prominent role in that. So look, I think there is just there's a deal clearly on the table there. So look, trading tariffs day to day could be fraught with risk. Is fraught with risk, and I think sort of the 2nd of April, this reciprocity day, could bring volatility. But I think we could have to brace ourselves. But I think we can wear the risk and sit tight through that, believing that deals will get done, the economy will avoid a recession, and therefore equities can perform through time.
I want to talk about one of the notes that you have here on the Mag 7. And you know that they've sold off hard, but you think, and of course, as they are still businesses with a lot of fundamentals tied to them, you still call them great businesses with good balance sheet strength. How does that translate through to the trading thesis on them?
Well, look, I think there's sort of a different time horizon. There's a multiple time horizons here. I'll keep it tight, but look, I think in the very long term, these are sensational businesses, so should be a prominent part of portfolios. And I think in the very short term, they've been oversold. And I think, people who have cash on to spend will remind themselves and revisit that this isn't a dot-com bust. These have tremendous earnings potential. Balance sheet, the delivery of earnings has already been sensational. Balance sheets are strong, and there are moats around those businesses. But I think really over sort of an 18-month, 2-year trade, a higher conviction view at the moment is to move towards European stocks. The valuation has always been sort of eye-catching there, but has offered little reward. But I think we've got the catalyst now with the fiscal expansion program, certainly undertaken by Germany, or seems to be in train, and that could release some demand that's been so absent in the prior years, if not decades. So Mag 7 looked like a good short, long-term trade, but I think if you're thinking about into the remainder of the year, over a sort of a 1-2 year time horizon, European equities, I think, look a little bit more primed than the Mag 7.
Specific sectors within European equities that should be prioritized over others from what you're kind of looking across and sensing in opportunities right now?
Well, I think the more sort of cyclical, value-sensitive areas, I think like financials, I know they've been a very hot area, so alert to some maybe shorter-term drawdowns there, and in industrials as well, given the defence stocks. But this is the area of keenest growth, where we would see, the investment programs to roll out defence expansion, infrastructure expansion, is going to be intermediated by the financials sector. Valuation, despite the strength of share price performance, valuations aren't that daunting. So I think the financial sector in Europe and the industrials are worth leaning into at this moment.
Ben, thanks so much for taking the time here with us this morning.
My pleasure.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got co-host of Market Domination, Julie Hyman, here with us on set. First up, Julie, we got to talk about CoreWeave, reportedly planning to cut the size of its IPO and the raise specifically. This is going to come in at about $1.5 billion, according to Bloomberg. They plan to offer investors 37.5 million shares at $40 apiece. That's down from 49 million shares at a range of $47 to $55 apiece. The company planning to go public Friday morning here. This just one of the companies that we're waiting to perhaps kind of break into the public markets and perhaps set the tone for some others this year too.
There's so much attention on CoreWeave for two reasons. One, as a sort of a measure of the AI trade, and two, as a measure of the IPO market, right? So on both of those fronts, this news is a bit disappointing, if not entirely unexpected, right? There were investors who were saying, oh, this is not going to price how it originally was talked about. NVIDIA is a big investor in this company. They own about 6% of it. And according to reports from both Bloomberg and CNBC, NVIDIA is going to anchor the IPO with an order for $250 million worth of stock. So increasing its stake there as the company goes public. It is very interesting what we've heard recently about AI. Microsoft, for example, has reportedly, according to some analysts, pulled back on its data center leases to some extent. Although, again, reportedly, TD Cowen out with a note recently saying that others like Meta and Google have stepped in. We recently talked to Gil Luria over at D.A. Davidson, who doesn't yet cover CoreWeave because it's not yet public, but he covers the likes of Microsoft and others. And he talked about what his expectations were when we talked to him recently about CoreWeave.
The deal may not even happen at these valuations, because what we learned about CoreWeave from their first filing was that Microsoft was a 62% customer, and then they have another 15% customer, which is either NVIDIA or Meta. That's spillover demand from Microsoft, Meta, NVIDIA. That not a type of revenue that investors typically want to put a very high multiple on.
And it's also incredibly concentrated revenue in just a few companies. So that's the AI part of it. And then, of course, there's the IPO part of it. As you know, everybody was all jazzed about the IPO market opening this year, and it hasn't really happened. And with each new high-profile company that prepares to come to market, it's like, is this the one?
Right.
Is this the one? And the fact that it is now doing it at a lower valuation, maybe it's not going to be the one, but we'll see how it trades on the first day.
Absolutely. Well, NVIDIA actually, to your point, adding a little bit of their own, kind of throwing their hat in the ring is actually a vote of confidence here. And that's not insignificant here. 1/6 of those shares essentially would be going to NVIDIA if it were to come out at this type of raise, $1.5 billion for the $250 million that they had put forward.
One more thing to mention here is when they came out with their filing for the IPO, they said they had material weaknesses in their internal controls over financial reporting. That was where, I mean, every company has to disclose risks to their businesses. In that filing, they talked about there that they had insufficient IT controls over their applications supporting financial reporting. So that's something to keep an eye on, not necessarily something that investors want to see.
That's not something I want to hear from an AI company either. You should probably be pretty good at those. I don't know. Anyway, next up, shares of Soleno Therapeutics are surging after winning U.S. FDA approval for its new drug to treat excessive hunger in people with Prader-Willi syndrome, a genetic disorder that leads to physical, mental, and behavioral problems. Being hungry all the time is a key feature of the syndrome, and analysts say that this approval is an important catalyst for the stock. Shares are moving to the upside, ripping higher by more than 40% during today's activity.
Yeah, you see this in the biotech world, right, where they hit and the stock goes up. That's because Soleno is a pre-revenue company. This would be their first product. So obviously, if they get a product, that would be a big deal. The product is called Vykat, if I am saying that correctly. It is indeed to treat this syndrome, which is a relatively rare syndrome, but you get these sort of rare disease drugs that can be a big hit. Because they are usually priced at relatively high levels. So that's something that is going to be in focus for analysts. Where is this going to be priced? And what is that going to mean for the future revenue of the company?
Yeah, one of those such analysts over at Piper Sandler reaffirming their optimistic stance. They have a $93 price target on the stock. And of course, we're looking at shares just jumping, as we mentioned a moment ago here. They're still a little shy of that price target for certain, at least here on the day.
Right, because maybe when they eventually actually start selling the thing and seeing revenue come in, maybe then there's analysts thinking more signs for upside, more room for upside. One more thing to mention here is with this approval, it's a so-called clean label without warnings, which some analysts were calling a best case scenario, where you don't want sort of warnings of dire side effects to be on the label that could limit the sales.
Good note. Julie, thanks so much for breaking this down.
Good to be here.
Appreciate it. President Trump imposing 25% tariffs on cars and car parts imported to the U.S. Some of those tariffs are set to take effect next week. The president's goal is to bring more car production back to the U.S., but many in the auto industry say the move will surely raise prices for American car buyers. Den Ives from Wedbush says tariffs in their current form would push the average price of cars up between $5,000 and $10,000 higher, depending on the make, model, and price point. Cars.com says that they saw a 2,600% spike in traffic on their article titled "Which Cars Are Made Outside the U.S." from Tuesday to Wednesday when we got the tariff announcement. Here to dig in, we've got Aaron Bragman, who is the Detroit bureau chief at Cars.com. Aaron, good to see you, and thanks for joining us on this. I mean, first, the sheer volume of people that are now looking for alternatives or just trying to confirm if the vehicle that they were interested in before this announcement is actually going to be able to kind of swerve around some of the new tariff announcements here. What are you seeing in the consumer mindset play out as of this juncture, early innings?
Right. Well, people are very worried about what the prices are going to do on a vehicle that they're looking at. But really, there is no safe space here. Every vehicle has at least some imported components in it as well. So not just vehicles that are imported into the United States, but also vehicles that are assembled here are also likely to see some price increases as well. And it's not even certain how much of a price increase we're looking at. We've seen, you said earlier, $5,000 to $10,000. We've seen some think tanks saying anywhere from $3,000 to $12,000. But the automakers aren't quite certain yet exactly how they're going to adjust these prices. Are certain models going to be affected more than others? Or in our idea of thinking, it's more likely that they're going to spread these cost increases out among all vehicles so as not to cause some price shocks on some potentially popular models like the Chevrolet Silverado, for instance, which is assembled in Mexico and Canada, but having something that's a bit more equalized. So you see these larger price increases aren't actually happening. Smaller price increases are happening on a much larger scale across more models.
And so all of these things in mind, how are we anticipating that manufacturers will react? And will there be a shift in especially how they're kind of looking across where their fleets are produced? Is there typically a knee-jerk reaction or even some precautionary measure that they've already taken in order to try and offset this?
Well, we've seen them starting to already try and hoard some parts, for lack of a better word, bring a lot of parts in ahead of these tariffs so that they're not going to be impacted when the tariffs actually start. But actually changing production, changing supply lines, that's something that takes years and billions of dollars of investment that they hadn't planned on making prior to a lot of these announcements. So it's not something that you can just simply adjust. In some cases, it might be possible. Some plants are a bit more flexible. So you can either make more of one model at a certain plant or try and bring in a model that's very similar or built on the same, what they call the vehicle architecture. But to actually change where you source a lot of these parts and where these vehicles come from is a multi-year endeavor. It costs a lot of money. It costs a lot of upheaval. It's basically undoing 60 years of free trade agreements and supply lines that have been very successful for everyone in North America for a very long time.
What can potential buyers, folks who are in the car market right now and going to dealerships, kicking the tires, what can they do to ensure that they're not going to get swept up in just the tariff talk by salespeople who are on the lot saying, hey, this is just going to cost you more, especially if the vehicle shouldn't be subject to it?
Well, the thing is, right now, there are no vehicles necessarily that are subjected to these tariffs. So if they're going to a dealer lot and they're seeing a dealer say, oh, this additional price adder that you see at the bottom of the sticker is because of the tariff changes, that's not a thing yet. So that's not something that should be allowed. You should actually challenge that if you see that on a sticker. Coming down the pipe in a couple of weeks, that could be a factor. You could see some price changes. But as of right now, no automakers have officially made any kind of price changes. So any kind of adders to that are something that should be challenged. But it's also, we think, key, if you're going to look at buy a vehicle over the next couple of weeks, now is the time to buy, because there is price volatility coming, and not just in the new car market. We're also likely to see that in the used car market as well due to demand. How do you think this will shift some of the most popular and most commonly sold used vehicles, since you brought up that market as well? Well, the used vehicle market's also very interesting. We've got a very low supply of used vehicles right now because coming off of the COVID years where we had a lot of depressed sales, there isn't a whole lot of those new vehicles that have made it into the used market. So as new vehicle prices go up, which they almost certainly will, demand for less expensive used cars is going to go up. And if you have a small supply of those used cars, that price is also going to go up, which is great if you're trading one in and you want maximum value on your used car. Not so great if you're looking to replace the vehicle you have with another used car. That just means it's going to be more expensive too. Yeah, we were talking about some of the elements from a J.D. Power report published yesterday, saying that the used market also being influenced by the emerging tariff-related price concerns. The effect not yet material, they say, but any increase in new vehicle prices, as you noted, Aaron, will inevitably lead to higher used vehicle prices as well here. Aaron, thanks so much for taking the time and breaking this down. My pleasure. Thanks for having me.
All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. We have some new housing data out today. Pending home sales rising 2% compared to the month prior, according to the latest data from the National Association of Realtors. But despite that rise, the NAR says contract signing remains well below normal historical levels. Joining me now, we've got Joel Berner, who is a senior economist at Realtor.com. Joel, good to see you. Thanks so much for hopping on Yahoo Finance with us. First, just take us into this home sales rise that we saw during the month of February and any continuity you're expecting.
Hi, Brad. Thanks for having me this morning. Yeah, we saw in February a pickup from January, which was a pretty slow month in terms of pending home sales, and a year-over-year increase as well from last February. So this is good news. And what we're really seeing is a bit of price softness in the market and more buyers taking advantage of that. We're seeing median listing prices fall a little bit, price reductions increase, and time on market increase as well. So it's a good time for buyers ahead of this spring buying season.
Switching gears slightly, you have a new report out about the persistent trend of bigger down payments. What are you finding there?
Yeah, what we're seeing is that down payments are increasing both in dollar value and as a percentage of the sale price. In the fourth quarter of 2024, it was the highest fourth quarter we've seen for down payments ever in the history of the data series. So why that is because we've got higher mortgage rates and people are savvy, trying to minimize the amount of their home purchase that they have to finance, trying to do as much of it with cash as possible to avoid these mid to high 6% mortgage rates. And what we're really seeing also is more sales on the higher end of the market. People who are in the move-up space rather than the first-time home buyer space. So people who have equity from a previous home are using that toward a larger down payment and ending up financing less of their purchase.
Okay, so that's what I was going to follow up with, because it's a range of sales that we're talking about here too, where at the higher end versus at the lower end, there's kind of like that balancing out. And I guess, are you saying that you're seeing a lot of the bigger down payments due to the higher priced homes being sold? And what does that tell you about the state of lower income buyers? Are they, dare I say, locked out of the market, or at least blocked out?
Yeah, so the higher dollar value is partially due to a higher percentage of the sale price, and also because the sale price is a little bit higher. We just saw that in the Case-Shiller Index, which came out earlier this week. So more expensive homes are being sold, so there are larger down payments on them. And the folks who are buying those homes tend to have owned a home already and can convert that equity into cash for a down payment. I wouldn't say that lower end buyers are totally locked out right now, but they are bearing the brunt of this high mortgage rate environment. It's tougher without any equity in a previous home to convert into a down payment, to buy a new home and finance a lot of that at 6.7%, which is about where we're sitting right now.
So what does that mean for the average millennial or older Gen Z to afford to buy a home right now? And if not, when does that opportunity become a little bit more apparent, kind of on a broad-based scale?
Yeah, what we're preaching is patience for first-time home buyers right now. We've seen for the last 19 months that rents nationally have been falling in the market for new rentals. So what we're hoping is that for folks who have been able to rent for a few years and save a little bit of money, they can have a higher down payment, kind of follow this trend of larger down payments and finance less of their purchase. We don't anticipate a lot of relief from mortgage rates in the coming months. We project low sixes by the end of the year, but that's a little ways off. So for the millennials and young folks looking to buy their first home, we're preaching patience. Save up as much as you can, make as big of a down payment as you can, and make sure that you find a home that really fits your needs.
What is within that outlook for 2025 that you were starting to go into for down payments? Do you anticipate that going to, or potentially continuing to grow?
Yeah, we do. Right now, we're seeing the average down payment at about $30,000 on a home, and we expect this to rise seasonally. These grow during the peak seasons of the home buying year, in the spring and summer, and to a lesser extent in the fall. So just some basic seasonality will lead to some higher down payments. But also, if there's not relief from mortgage rates, we're going to continue to see the same trends that we've been seeing.
Joel, thanks so much. Joel Berner.
Thank you, Brad.
Certainly. Coming up, you have less than 20 days before your taxes are due. Look, it's not me making that up. It's just the dates. We've got tips for the last minute filers out there. Let's get a check on markets as we are 2 hours into the trading session on the day. We're taking a look at the Dow Jones Industrial Average. Let's load that up here. We're lower by about 0.1% on today's activity. Over the course of 2025, year to date, you're seeing declines of 0.3% there. And then additionally, taking a look at the NASDAQ composite here on the day, you're seeing some fractional gains up by about 0.1%. Year to date, though, it is still down 7%. And the S&P 500, you're taking a look at some gains there on the day by about 0.1%, so fractionally higher there. We still got some work to do to get into the positive gains party, though, on the year-to-date scale. Let's take a look at some of the heat maps that we've got fired up. We'll dig into today's tape just a little bit more for you. Technology right now, and let's put that on today's activity. Yeah, today's activity, it's down by about 0.5%. Just to give you a better look at what's transpiring intraday, that was a longer-term view that we had fired up there. Somebody was checking their stats within the Wi-Fi Interactive a little earlier on. But taking a look at today's activity, you've got technology pulling up the caboose. It's down by about 0.5%. However, leading the pack, you've got consumer discretionary. Take a look at that movement that we're tracking here on the day. Started off the day in negative territory, now higher by about 1%. You got more gainers than laggards here on the day. And then additionally checking in on the tech-heavy NASDAQ 100. Here's a look at some of your mega cap tech stocks here. Seeming a little mixed. You got Tesla up by 5% right now. However, a little bit of a pullback that we're seeing, fractionally as it may be, in NVIDIA, Alphabet, and Meta platforms on the day. You still got some gainers to the upside for Apple, Amazon, and Microsoft of the mega cap tech names in the market. And just lastly, let's ride out with a look at the Dow Jones Industrial Average. I'm actually going to zoom through this one and just give you kind of a split heat map because that's relative how we're looking right now. Still more green than negative. Pulling up the caboose, you've got Goldman Sachs. But here's why I wanted to speed through, so we can get to some transports on the day. And these are not actually all the car companies that we were keeping tabs on here. Let me get on over to the cars for a hot second, just so you can see where some of that mobility trade is moving around off the back of the announcement of those 25% tariffs set to take effect early April, and then on parts as well. We're going to be looking out into May, but here's a look at some of the auto dealers and how those names are moving on the day as well. Here's a little bit of a look at the mobility trade with some of the, well, not so much the car play here, but Hertz actually is catching a huge bid. That's up by about 18% during today's activity. They sell some used cars as well. So far, Americans are filing their tax returns a little slower than they did last year, with just over 70 million returns received by the IRS as of March 14th. If you still haven't filed yet, we've got Lisa Green-Lewis, TurboTax CPA and tax expert, here with some last-minute filing tips. Lisa, if you haven't started your taxes yet, what should you be doing this weekend?
Definitely going online and e-filing with direct deposit. E-file with direct deposit, that's the quickest way to get your refund. And, you know, the average refund is over $3,000 for many people. That is the biggest check that you get all year.
So what is the biggest mistake that you see people make on their taxes?
Yeah, I would say just procrastinating. People who wait, they tend to leave important things out of their tax return. So you want to gather all your documents in one place, you know, documents that report your income, like your W-2s and 1099s, and then also forms and receipts for those expenses that can be deductible. Also, people that have kids, sometimes they gather the incorrect Social Security number. And so you need those accurate Social Security numbers in order to claim those valuable deductions and credits for your kids. And also, I would say not filing at all. There are some filers that make under the IRS income threshold, but if they've had federal taxes taken out of their paychecks or are eligible for refundable credits like the earned income tax credit, then they should still file because they may be leaving money on the table.
Now, President Trump has made some suggested changes to the tax code. How would no income tax change things for most Americans?
First thing I want to say on that, because there's a lot of confusion about the proposals, those proposals do not impact your 2024 taxes. So just want to emphasize that because I think people are holding off hearing these tax law changes, but no taxes on tips. So right now, you know, tips are taxed at a certain amount. No taxes on tips would mean that income would be tax-free if that did come about. And there would be less paperwork for filers and the employers as well.
Yes, and a key note that this is not in effect yet, and ultimately
Right.
still needs to be worked through Congress. There's a lot of paperwork until it actually flows through to the paperwork that people are filing right now. We do know that Republicans are planning to extend the 2017 tax cuts. So what happens if that is not successful here? Is there a material change to the way that we could file next year or the year after?
We don't know what the tax laws would be. One thing I can say is TurboTax, we've been in business for over 30 years. We've gone through so many tax law changes, and we will be ready and up to date, with our tools, our tax software, as well as our tax experts.
What are the biggest things that people should be double checking on their taxes as they are filing for this go round?
Yeah, so there are so many deductions and credits out there, but I want to highlight some key tax deductions and credits you don't want to miss. So 90% of filers do claim the standard deduction, and that was adjusted for inflation. So if you're single, it's $14,600. Married filing jointly, it's $29,200. If you're a parent, you can get the child tax credit up to $2,000 for all of your kids each of your kids under 17. If you sent your child to daycare or even summer camp, you can get the child independent care credit, and that's up to $1,050 for one child, up to $2,100 for 2 or more kids. There are some key credits that the IRS reports that 1 out of 5 filers that are eligible do miss those. The earned income tax credit is one of them. That's a substantial credit for a family with 3 kids. It's up to $7,830. There's also the savers credit. That is a credit you get just for investing in your retirement. And that is up to $1,000 if you're single and up to $2,000 married filing jointly.
Lisa, thanks so much for taking the time, breaking down some of the key reminders that people need as they're going in to file their taxes. I guess this is last minute. We're a few weeks out here, but I've taken it closer to the wire before. So this is still plenty of cushion for some people out there. Thanks so much, Lisa.
Thank you for having me.
Certainly. Coming up, the cost of college is on the rise. We have advice for incoming students and parents on saving for education. Tuition costs have soared past other household expenses, increasing 900% over the past few decades, and saving for college has become more important than ever. According to JP Morgan, families now pay 48% of higher education expenses through their income and investments, up from 38% just 10 years ago. Here with more on how households should think about saving for education, we've got Tricia Scarlatta, who is the head of education savings at JP Morgan. Very important topic. You've got, of course, some who are finally getting to the stage, to the podium, and they're going to hear that commencement speech and they're going to be done. And then you have others whose families are going to say, okay, all right, how are we going to prep you for the next 4, maybe 5 years? So as we think about the cost of college planning, just to start off, what are the considerations that families need to be keeping in mind?
I think just that, know the cost.
Yeah.
A lot, we see in the news or we hear people talk about how expensive college is. Understand what it really is. Mm-hmm. So knowing that, public in-state tuition is around $25,000, public out-of-state is about double, so it's about $50,000, and private is close. There's some institutions that are almost $100,000 now. So know those costs, but then know your net cost. Mm-hmm. So understand what you might get in financial aid, which is never as much as we'd like it to be, but understand what you may get, and that helps you know your number.
Certainly.
Start there.
What is the calculation that families, that households, that students should also be running on the return that they're going to get for the money spent to get that degree?
Look, there's always going to be the argument that it's so expensive, is it worth it? The numbers say that it is. So the numbers say the difference between a high school and a college degree is about $40,000 a year. That's a lot of money. So if you think you're earning $40,000 more in a year, that pays for almost 2 years of in-state public tuition. So look, kids these days, you know, Brad, we know, they have, the sky's the limit. There are so many options. The nice thing about a 529 plan is it doesn't have to only be used for 2 and 4 year institutions. You know, it now includes apprenticeships, vocational schools. So like the world, 529 plans have become more flexible as well.
What are the two different types of 529 plans that people should know about, and what's the core differences that we see between them?
So I think what you're asking is the advisor sold versus direct sold. So you have the ability as you know, a parent or anyone for that matter to go into an account directly. So you can go online, go to your state's plan, and you can invest directly in that plan. You also have the ability to go with an advisor. So some folks want that guidance, want the help of an advisor, so you certainly could seek that out. Plans are different. I would say advisor-guided plans have probably more options. They're more active managed plans, where you'll see the direct sold plans, typically less options and more index type of investments, but very similar in the structure, but you always look at those underlying investments.
And then when it comes to financial aid, once you've had to apply for it, once you do the assessment and run the kind of calculus around exactly how much you still need to get covered, how much does financial aid actually cover in that kind of reality check that many go through?
Not a lot, not as much as you would hope. So obviously it's going to be different for every family, but to give you an example, the average family last year got about $12,000 between grants and scholarships. Now remember, grants are always going to be need-based. So if your income is higher, you're not going to get those grants. Where the most dollars are the scholarship and merit money. So that's where I always push people. We want our kids to do well in school, but that's where the most dollars are. On average, you may see about maybe 20% of the cost. It could be covered by aid. And remember, not all aid, when you get that package, it's not all free. They're always going to put in all those loans. So look at that package or look at that, you know, acceptance letter that you get from the institution. Look at it closely, because I bet you a lot of it is loans and not true aid.
What is the good new rule of thumb for how quickly you should be able to pay off what you've aggregated in expenses over the course of college? As we know that most people have to take out a loan of some sort or another. Paying down that loan, though, then becomes a challenge after you graduate.
Certainly. I mean, you want to try to get it down as quickly as possible. And most are 10 years. Okay. Some go out further. I would say, you know, look, people that have student loans, they're putting aside other goals because they're trying to pay that off first. So, but the reality is last year, 41% of families took out loans. The average family last year graduated from college with $55,000 between parents and students. So the reality is people typically need to get that help. I would say if it's a loan that can be refinanced, certainly look at that. If interest rates continue to come down, certainly look to see if there's an opportunity to refinance.
Tricia, thanks so much for taking the time here with us in studio.
Always a pleasure.
Likewise. Coming up, everyone, a crossover between spring cleaning your home and your finances. Will tell you exactly what paperwork you need to save and what you can just toss away. Put it over the shoulder. A programming note. On this week's episode of Stocks in Translation, Jared Blickery and Sydney Freed sit down with Crossmark Global Investments Victoria Fernandez to talk about having holds with high liquidity and why money has been flowing into treasury markets as of late.
So you always want to have holdings in your portfolio that do have high liquidity because you want the flexibility to be able to trade them easily. You don't want to buy something, have it in your portfolio, need to sell it, and you can't because there's no one on the other side willing to take that bond from you. And so that's why you've seen a lot of money flow into treasury markets because that is your most liquid asset that you have. But tying that again to how much money is flowing in the market as a whole drives yields. And so having extra cash in the market that you didn't have before brings yields down.
You can watch Stocks in Translation every Tuesday and Thursday at 8:30 a.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. As we wrap up the first quarter of the year and head into spring, we're looking at all of the ways that you can spring clean your finances and set yourself up with good financial habits for the rest of the year. Today, we're focusing on organizing your financial paperwork. One thing that can feel like a very daunting task. So here with more is Grant Gallagher, who is the Affinity Federal Credit Union Director of Financial Wellbeing and Brand Communications. Grant, good to have you here with us. You have a bunch of great tips for people here, so we got to know, how can they start to create a financial filing system to keep themselves organized?
Thanks for having me, Brad. Yeah, obviously people don't get very excited when we're talking about doing your financial paperwork, tidying up. Most people, they don't really have a system in place, and that's really the first thing they need to think about. They need to create a system. They need to organize it by category. You need to involve anybody in your family who's part of that conversation. Obviously, if your documents are locked up in a fireproof safe and they need to get access to it, but you're at work, it's not going to work for your entire family. So having that conversation and kind of figuring out those first steps is where you need to start.
What's the decision tree as well for documents that you should keep versus shred versus digitize even?
So I'm a big proponent of you should really digitize everything that you can. It's very little effort to have a digital file, and then you get the benefits of you can potentially search for it. You can get some additional benefits there. But it really depends on what sort of document you're talking about. When we're talking about, your tax-related paperwork, those have a much longer shelf life. Those you want to keep on file for quite some time. If you are going to look at something like a bill, bills that have been paid, you can usually, get rid of those immediately. Bank statements, those have a little bit of a longer shelf life. You're going to want to keep those around for a year unless you need them for some sort of tax purposes. Pay stubs are also generally only useful as a backup to your W-2 at tax time. But unless you're self-employed or have really complex taxes, then, you need to keep those longer. Then, of course.
Sorry, go ahead.
Yeah. Then, of course, if you have any sort of insurance policies, you want to keep your active policy on hand and accessible, but anything that's expired or renewed, you want to keep it around for 3 years, just in case of disputes, claims, or legal issues.
So that starts to answer the question of how long you keep certain documents, but also here, when you're thinking about the importance of a financial emergency binder, it seems like there are certain documents that should go in that binder, stay in that binder for as long as necessary. What goes in there and the preparedness of that binder?
Yeah, that's a great point. I don't think a lot of people have an emergency financial binder, and they absolutely should, because the last thing you want during a crisis is have to be digging around to try to find all these papers. Things that are important to go in there is loans and credit card account numbers, housing and utility account numbers, insurance information, identity papers, property titles, tax and employment records. Of course, medical information is important. Wills and power of attorney. And then, of course, you want to have your emergency contacts, your doctors, the schools, the utilities, as well as any sort of passwords for computers and accounts. These are all things that you don't really think about, and you might have trouble remembering if you're in a crisis situation. And then last but not least, I always recommend that people make copies of the front and back of their debit cards and credit cards, because they put that number nice and conveniently right on the card. But when it's lost and stolen, it's not so convenient that it was on the card and not in your wallet or having a copy of it.
We're just a couple weeks out from tax day. Maybe people had a tough time organizing all their files this year. What do you advise for people to get ahead for next year's tax season?
Yeah, now is the time to learn from your lessons and your mistakes from this year and start now. Put together a folder now of what a place where you can put these documents. It's a good opportunity to, think about what did you miss, what did you have to dig for, and take advantage of that. Start putting your donations in that folder. Start thinking about how you can better organize it, because, again, you don't want to be tempted to have some important document and just stick it in a pile for later. A lot of us kind of get lazy about that, but do your future self a favor, create some sort of filing system for next year now. And then, you won't have to worry about it, and it'll be a much smoother tax season next year.
And so with that in mind, how do you see a lot of the older generations kind of passing down their tips for which files they need to be keeping versus digitizing to the next generations that are digital first?
Yeah. There is a little bit of a challenge there with somebody who's traditionally a paper first individual. You can help them out by helping scan them, helping teach them how to do these things. But of course, if they're sticking to a paper first file, they should really make that their plan. You shouldn't do half paper, half digital. That's just going to lead to some scenarios where you're digging around looking for a paper because you thought you digitized it, but you didn't actually do it.
Yeah.
And I am speaking from personal experience here.
Grant, thanks so much for taking the time here and for sharing the personal experience as well. Appreciate it.
Thanks,
Everyone,
Brad.
That's it for Wealth. I'm Brad Smith. Thanks so much for watching. You can stay tuned for Market Domination coming up at 3 p.m. Eastern Time.